In the span of 48 hours, gold did something it is not supposed to do. It didn't drift. It ripped through $5,000 an ounce, pushed into the mid-5,000s, and then snapped back with a single-day drop of more than 9%. For an asset that generations were taught to treat like ballast, that is a violent modern market move. And it matters because the move wasn't isolated. It arrived with the kind of speed that usually shows up when something behind the curtain is being repriced, not politely debated. Here's the number that should stop you: 5,000. That level isn't just psychological. It is a public line in the sand that people have argued about for years, like it's a fantasy target, like it belongs to a different era. But gold didn't tap it politely. 82 an ounce before the market whipped around. That overshoot and reversal is what you see when positioning and leverage collide with a real-world constraint, and the market has to discover price quickly. And that's where this gets uncomfortable. Most people will explain the move with one sentence: "Aw." But none of those explanations accounts for the speed, the magnitude, and the way the market behaved as if it was trying to clear an imbalance immediately. Not months, not weeks, in 48 hours. They said gold could never trade like this. They said it was too deep, too mature, too stable. Yet it traded like a stressed asset, because for a moment it was one. The most important part is the information gap. By the time a price spike hits your feed, institutions have already acted. They already rebalanced. They already hedged. They already found the liquidity or protected against it. The public gets the story after the move. The institutions get the signals before the story. And what I'm about to lay out is not a prediction and not a conspiracy. It's a pattern you can test, and the math behind why gold to 5,000 talk keeps coming back right when the system is quietly signaling stress. Welcome to Signal Ledger. This is where we decode what matters before its headlines. We track flows, contradictions, and incentives that force markets to do what they do. If you like analysis that respects your intelligence, consider subscribing the way you'd keep the number of a wise elder who always sees the setup early. And drop a comment with where you're watching from. Because gold looks different depending on which currency you live in and which economy you're feeling every day. Now let's reconstruct what actually happened, because the details are the story. It sprinted. Gold cleared 5,000, accelerated higher, and then gave back a chunk of that move with a sudden, sharp sell-off that was large enough to make longtime gold watchers do a double take. A one-day drop north of 9% is not a normal gold headline. In quieter decades, that would be the kind of move that defines a year. Here it happened while gold was already behaving like it had momentum, which is exactly why the reversal matters. When an asset moves like that, you ask three questions. Who was forced to act? Who had to provide liquidity? And what changed in the cost of holding risk? This is the part no one likes, because it pulls the conversation away from slogans and into plumbing. A fast spike is often a scramble. Hedges get adjusted, options dealers rebalance, and short positions that were fine yesterday become impossible today. Then, when the move goes too far too fast, the same system that pushed it up can push it down, because the same positions that were forced to cover on the way up become forced to reduce on the way down. At the same time, the paper market didn't freeze, it roared. In one recent session, benchmark gold futures traded around the high 4,000s with reported volume around 211,728 contracts. If you've never translated that into reality, here's what it means. A standard gold futures contract is 100 troy ounces. Multiply 211,728 by 100, and you get 21,172,800 ounces of exposure changing hands in a day. $9 billion of notional value turning over. In one day. That's the paper ocean, moving at the speed of risk appetite. And now compare that to the physical ocean. Gold is real metal. It comes out of mines. It gets refined. It gets shipped. It sits in vaults. It doesn't teleport. Even if there is plenty of gold in the world, the amount that can be moved, delivered, and reassigned quickly is limited by logistics, financing, and willingness. So you have a situation where paper exposure can churn over $100 billion in a session, while the physical side has frictions that don't care about your screen. And that tension is where dislocations come from, and dislocations are where outsized moves are born. Then you zoom out and you see the institutional layer. Central banks have been buying gold at a scale that most people still underestimate. In 2024, official sector purchases totaled about 1,045 tons. 1 ton is roughly 32,150 troy ounces, $7 million of metal. Multiply by 1,045, and you're looking at around $168 billion of gold absorbed in a single year at today's price level. That's not a headline trade. That's a balance sheet decision. 3 tons. 3 tons at 5,000 an ounce is still roughly $139 billion of metal. That is not a trivial shift. It is the difference between a steady institutional bid and a frantic one. And it matters because what replaced it was just as telling. In 2025, reported investment demand surged 84% to about 2,175 tons. At 5,000 an ounce, that's roughly $350 billion of implied demand pressure entering the story. Here's where it gets interesting. People love to debate whether 5,000 is reasonable, as if the market is voting with opinions. But the market clears with constraints. If the float is smaller because official buyers have been removing metal, and the marginal demand rises because investors are trying to catch up, the price does what it has to do to balance the claims. That's the math that gets ignored when someone throws out a target like it's a meme or dismisses it like it's impossible. To see why this pattern keeps repeating, you have to look backward. Gold doesn't start behaving like a leveraged asset for no reason. When it does, it's often because the system is repricing trust. In 1979, inflation and policy confusion pushed gold into a parabolic move. The result was not just a high price. The result was a shock to expectations and a long period of rebuilding credibility. In 1980, the spike didn't happen because everyone suddenly liked gold. It happened because confidence in the value of currency was being tested and the market needed a reference point. Then look at 2008. The crisis wasn't a gold story at first, it was a credit story. Gold didn't peak on the day the first bank collapsed. It climbed as the response unfolded. Liquidity facilities, emergency actions, and balance sheets expanding. The result was a multi-year move that culminated around 2011, when gold reflected a world forced to accept a new baseline of intervention. Different decade, same mechanism. When the rules of money change quickly, gold becomes the measuring stick. Now look at 2013. That year is useful because it shows the other side of the playbook. As policy expectations shifted, gold suffered a major break lower and sentiment collapsed. The lesson is that gold is sensitive to perceived credibility. When the market believes the system will hold together with tighter policy, gold can deflate. When the market doubts that credibility, gold can reprice violently. The switch isn't ideology, it's confidence. Then you get the post-2020 regime, a global shock, followed by the most aggressive policy response in modern memory, followed by the realization that temporary measures cast long shadows. The result was a world where the conversation about reserves, sanctions, payment rails, and fiscal dominance became more than academic. It is a neutrality hedge. It is an asset that does not require someone else to perform. Now, with gold surging through 5,000 and moving with unusual volatility, the pattern is tightening again. A volatility spike, multi-year official accumulation, and a demand handoff toward investors show up together. When they do, the market is telling you the regime is under review. Not by commentators, by balance sheets. Now let's name the players, because markets are not abstract. They're institutions making decisions under constraints. Start with the futures exchanges and clearinghouses. Their job is to make sure trades settle and losses get paid. When volatility rises, they manage risk by changing margin requirements, tightening controls, and forcing participants to post more collateral. That is not drama, that is survival. And it matters because when margin requirements rise, someone somewhere has to come up with cash or reduce exposure, and that action can become a wave. Then there are the bullion banks and dealers. They sit between paper and physical, managing inventories, hedges, and funding costs. They borrow, lend, swap, and warehouse. They make markets when the market is calm, and they withdraw when the market is stressed, not because they're villains, but because their risk models demand it. Then there are the sovereign actors, central banks and reserve managers. It's to protect national balance sheets, payment capacity, and stability. When they buy gold, they are reducing dependency on someone else's liabilities. When they accumulate year after year in the thousands of tons, they are telling you something about how they perceive the future of reserves, even if they never say it out loud. And then there are the vehicles that translate sentiment into scale: funds, ETFs, managed futures programs, and institutional portfolios. These players can turn a narrative shift into real flow quickly. If a large portfolio decides that a 0.5% allocation to gold should be 1%, that sounds small. But in a world of multi-trillion-dollar pools of capital, that small change can represent tens of billions of dollars of demand. That is why the marginal shift matters more than the average opinion. This is the part most people miss. Gold's price is set at the margin, but the marginal participant can be huge. In a normal environment, the marginal participant is a mix of hedgers, jewelers, speculators, and long-term allocators. In a stressed environment, the marginal participant is often a forced actor, a short position that must cover, a dealer that must hedge options exposure, a fund that must meet redemption, a clearinghouse that must reduce risk. When forced flows dominate, the market's behavior stops looking fundamental and starts looking mechanical. Now let's talk about the dislocation, because this is where the story stops being comfortable. On one side, you have the paper market showing enormous liquidity and turnover. On the other side, you have a physical market that is slow, segmented, and sensitive to financing. These two worlds are normally linked by arbitrage. If paper gets too cheap relative to physical, metal should move toward delivery. If paper gets too expensive, metal should flow out, or paper should be sold. But arbitrage is not magic. It requires balance sheet capacity, it requires credit lines, and it requires confidence that counterparties will perform under stress. When funding costs rise, carrying physical inventory becomes expensive. When risk appetite falls, balance sheets shrink. When volatility rises, haircuts get larger and lenders demand more collateral. All of those frictions can cause a wedge between paper and physical, not because the gold isn't there, but because the ability to mobilize it becomes constrained. That's why you can have a market that looks liquid on a screen while participants in the physical chain behave as if liquidity is scarce. So when someone says gold can't go to 5,000, ask them what they mean. Do they mean the world has too much gold? Or do they mean the market structure can't reprice that fast because we just watched it move through that level in real time? Do they mean the macro story doesn't justify it? Or do they mean they can't imagine the flows that would force it? The market doesn't care what feels intuitive. The market cares about clearing. Here's a simple analogy that captures the mechanism. Imagine a stadium with two entrances. One entrance is wide and fast, and people can rush through it by the tens of thousands. That's the paper market. The other entrance is narrow and slow, and it requires tickets, checks, and security. That's the physical market. Most of the time, the crowd is balanced, and the entrances don't matter. But if a sudden surge hits, the wide entrance floods first. The narrow entrance bottlenecks. The crowd doesn't disappear. It piles up, and the pressure finds the weakest points. Now add leverage to the story. Leverage is like giving the crowd megaphones. It amplifies movement. In gold, leverage exists through futures, options, and leveraged funds. When the price rises fast, shorts face rising losses and dealers must hedge. That can create buying pressure that feeds itself. Then, when the move becomes unstable, risk managers and clearinghouses demand more collateral. Some players can't or won't post it, so they sell. That selling can be just as violent as the buying because it's not a choice, it's a requirement. This is why a 9% one-day drop can coexist with a long-term bull narrative. The drop doesn't disprove the trend. It reveals that the market has become crowded and mechanically sensitive. It reveals that the path is not a straight line. And it tells you that if gold is moving like this, other parts of the system are likely under pressure too, because gold doesn't usually become the most dramatic tape unless something deeper is shifting. Now let's put the evidence in a tighter frame. We have a market that can rotate roughly 211,728 futures contracts in a session, 3 tons in 2025. We have investment demand surging 84% to 2,175 tons in 2025. These are not vibes, these are quantities. And quantities matter because the gold market is not infinitely elastic at the margin. There is a common misconception that because gold exists in large cumulative amounts, the market cannot face constraint. But constraint is not about total metal in history. It's about available float at the price, right now, under current financing terms and under current risk appetite. If a significant portion of metal is in long-term hands, central banks, sovereign wealth, strategic reserves, family holdings, it is not available for immediate delivery without a change in price that convinces someone to part with it. So what happens when demand ramps up faster than float can respond? The price rises until it finds a seller. That's the most basic market law. But in gold, there's another layer. Paper claims can expand much faster than physical. That means price discovery often happens in the paper ocean first. If the paper price rises, it can pull physical higher. If the paper price collapses due to forced liquidation, it can push physical lower, even if physical demand remains firm. That is why you can have contradictions that sound impossible if you only think in headlines. This contradiction is the center of the mystery. How can gold be in demand and still fall hard? Because demand is not one thing. There's long-term strategic demand and short-term leverage demand. There's demand that holds through volatility and demand that must exit when risk limits are hit. The market price at any moment reflects the battle between those two. Now, what does this imply for the future without turning this into a prediction? Historically, when gold enters a high volatility repricing regime, several paths tend to follow. In the conservative path, the market digests the move. Volatility compresses. Price consolidates into a higher range, while participants rebuild positions and adjust hedges. In that world, 5,000 becomes less a target and more a reference point, a new anchor for expectations. In the moderate path, the dislocation persists. Paper activity remains elevated, and the physical chain shows recurring stress in the form of tightness, longer delivery times, and higher costs to mobilize inventory. In that world, price swings stay sharp because the market is constantly balancing fast paper flows against slower physical realities. This is where you see repeated spikes, repeated pullbacks, and repeated headlines that sound contradictory. In the aggressive path, an additional shock hits the system. A a funding squeeze, a counterparty event, or policy shift that changes the cost of holding and delivering metal. In that world, the market can overshoot to levels that sound impossible right up until they print, not because anyone called it, but because the clearing price has to rise enough to ration demand and coax supply. The key point is that the mechanism is structural, not emotional. So what should be watched? Watch volatility, because sustained high volatility in gold often signals deeper stress rather than a one-off headline. Watch the persistence of investment demand figures, because an 84% surge is a regime signal if it stays elevated. Watch the official sector, not just annual totals, but the continuity across time, because steady accumulation is different from a panic bid. Watch futures market activity and open interest alongside price, because it tells you whether the move is being driven by new participation or by forced liquidation. One more detail ties it together. When gold becomes headline volatility, it often pulls attention away from quiet signals in credit and currency markets. If you see gold spiking while real yields whipsaw, while funding markets tighten at the same time, or while currencies gap on policy surprises, that's the same story told in different languages. Gold is simply the loudest messenger. The other messengers are there if you listen. And now the choice ahead, because every major market episode creates a split. The split isn't between optimists and pessimists. It's between people who watch narratives and people who watch constraints. Those who only consume stories tend to arrive late, because stories are written after the move. Those who watch flows see the move forming, because flows show up before the headlines. It's not about being smarter. It's about looking at what institutions must do, not what they say. Institutions move first here. Central banks didn't wake up in 2024 and buy 145 tons because of a trending hashtag. Investors didn't surge to 2,175 tons of demand in 2025 because a commentator sounded confident. Those numbers are the footprint of a regime shift in how capital is being sheltered. 82, then dropping more than 9% in a day. That is not a random tantrum. It is the market rehearsing a new set of rules. Gold 5,000 talk is back because price is not just a number, it's a message. When an ancient asset starts moving with modern volatility, it often means the system is repricing trust, and the marginal buyer is bigger than most people can imagine. The math they ignore is the math of scale. Scale of flows, scale of leverage, scale of constraints, and the speed at which the marginal dollar can force a repricing. This is Signal Ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether markets will keep sending signals. The question is whether those signals will be understood before they become obvious.